Hyman mentioned earlier, one theme in the annual report this year is the realignment of the global economy. And let me explore one aspect of this, which is the large adjustments of exchange rates that we've seen so far this year, and indeed in the previous year. Now, I know that this is a topic that has occupied many of you, indeed most of you. Let me explore a couple of new aspects, perhaps. Now, the impact of exchange rate adjustments on emerging economies has been much discussed, and we're beginning to gain some knowledge of some of the mechanisms involved. But perhaps less well known is that some of the same forces that impact emerging economies are also at play in advanced economy currency markets as well. And let me explore two issues in particular. So for one, the breakdown of covered interest parity that has been remarked recently in advanced economy currencies turn out to be quite closely related to the same mechanisms that affect emerging economies. And I will say more about this shortly. On financial stability, on a more financial stability theme, it also turns out that the impairment of market liquidity is also intimately tied to some to the same themes. So let me start my presentation by kicking off with a discussion of market liquidity and how market liquidity is closely bound up with the leverage of financial intermediaries. Now, we know that market liquidity depends on the ability of dealers to absorb demand and supply fluctuations and to take on exposures onto their own balance sheets. And dealers finance these asset positions by borrowing in capital markets. And so this is why funding liquidity, in the sense of the ease of credit conditions in capital markets, is very closely tied up with market liquidity. Now, if we just look back to the recent past, we can see that funding liquidity has fluctuated a lot. If we think back to the period before the crisis, we still have fresh memories of the ample liquidity provided by financial intermediaries in the run-up to the crisis. And let me illustrate that with these two charts. The left-hand chart shows you the total assets of the US broker-dealer sector, and that's the line in yellow, scaled to 100 at the beginning of 1990. And I have also plotted for comparison the total assets of the US non-financial corporate sector, and that's the line in blue, and the total assets of the US household sector, which is the line in red. Now, if you look at these three series, you can see that the broker-dealer sector grew much faster than the rest of the economy. At the peak of the boom in June 2007, assets of the broker-dealer sector had grown more than tenfold from 1990, whereas the assets of the non-financial corporate sector and the household sector had grown by a factor of 3. Now, the right-hand panel shows you the leverage of the broker-dealer sector, defined as total assets over equity. The leverage started out at 22 in 1990. It rose to close to 50 at the peak, and then subsequently fell sharply with the onset of the crisis in 2008. If you compare these two charts, you can see that at least for the short horizon, the fluctuations in total assets are more or less mirrored one-for-one by the fluctuations in leverage. Now, what we see, though, is that more recently, the sector's leverage has decreased further in the last couple of years. The leverage of the broker-dealer sector at the end of 2015 stood at 18. And that is lower than at the beginning of 1990. So there's something going on. Now, some market commentators mention regulation as one factor behind the decline in the risk-taking capacity of the dealer sector. Now, regulation is certainly tighter after the crisis, and a more realistic pricing of liquidity has been one of the intended effects of post-crisis regulation. At the same time, though, it's worth remembering that regulation is not the only constraint on leverage. If we look at both of these charts, the sharp deleveraging in late 2007 and into 2008 was due to tightening market conditions rather than in new regulation as such. And when we look at the most recent developments, we can ask, are there similar market developments at play which could explain the decline in leverage in the most recent period? Now let me introduce this discussion by discussing the failure of covered interest parity. Covered interest parity is the well-known proposition in international finance, which, to the effect that interest rates implicit in foreign exchange markets are consistent with the interest rates in money markets. And if you look at the left-hand panel, which is for a longer horizon, it goes back to 2004 until the most recent period. And the right-hand panel, which is just the most recent period magnified, we see that if we go back to the years before the crisis, the gap wasn't there. So what these charts show you is the difference between a money market interest rate given by the US dollar LIBOR, this is at the 3-month horizon, and the FX swap implied dollar interest rate. And this is from the forward rate that's implicit in the FX swap. So if we look at this chart, which is measured as the US LIBOR minus the FX swap implied dollar interest rate, these numbers are negative, which means that you pay more to borrow dollars in the foreign exchange market than you do in the money market. And these charts are up to the most recent period, but doesn't include the action on Friday. So we will have seen, well, we saw a slight increase, certainly for some of these currencies. Now, and the different series give you the currency involved in the FX swap. So think of it as a collateralized loan. So I'm lending euros in exchange for dollars, or pound sterling in exchange for dollars, yen in exchange for dollars, and so on. And from the divergence of these series, you can also see that depending on which currency you put up as collateral, so to speak, the interest rate on the dollar also varies. Now, in textbook settings, when someone can borrow and lend without limit at prevailing market prices, of course, this kind of deviation from covered interest parity could not hold. And that's because if such a difference existed, you could borrow at the low interest rate and lend out at the high interest rate, and you could just magnify that kind of position without limit, and that would serve to close the gap. But in practice, we know that that's not possible. In the textbooks, there are no banks, for example. But in practice, we would execute these transactions through banks, and executing such a trade would entail a sequence of transactions and make demands on the risk-taking capacity of intermediaries, such as the dealer banks as well as the counterparties. And if the risk-taking capacity of the dealer banks are limited by regulation or by constraints imposed by market conditions, then the gap between the two interest rates may not close, and this is clearly what we see. So we may ask whether the breakdown of covered interest parity reflects binding regulatory constraints or something else, specifically fluctuating market conditions. Well, it turns out that the breakdown of covered interest parity is very closely connected with a market risk factor, specifically the exchange rate against the US dollar. And let me demonstrate that through this chart. So what this slide shows you is the value of the US dollar, and that's measured in blue, calculated as a simple average of the bilateral exchange rate against 6 advanced economy currencies. And here the time period is between the beginning of 2007 until the most recent period, but it doesn't include the action on Friday. And you see that these gaps fluctuate a lot. The red line is the cross-currency basis, which is the difference between US dollar LIBOR and the FX implied dollar interest rate. You see that before the crisis, the red line hugs the horizontal axis very closely. That's to say, there was no deviation from covered interest parity. But since the crisis, it's really diverged quite a lot. And for these currencies, and for most currencies, in fact, except for a few, like the Australian dollar and the Canadian dollar, it turns out that the gap is negative. That's to say, you pay more through the FX swap to borrow dollars than you do in the open market. But let me just draw your attention to this striking reflected symmetry, which is that whenever the blue line goes up, the red line comes down. That's to say, whenever the dollar strengthens, the deviation from covered interest parity becomes more severe. And if you look at the most recent period, when the dollar started to strengthen in the middle of 2014, that's also when the cross-currency basis started to diverge quite a lot. Let me just illustrate this also with just the bilateral exchange rate with the euro. So the blue line is the value of the dollar vis-a-vis the euro, and what I've done is I've taken the reciprocal of the usual exchange rate quote, which is the euro dollar. Now, this is the dollar euro, if you like. And when the blue line goes up, this is when the dollar strengthens. And I've also plotted in red the cross-currency basis of the euro vis-a-vis the dollar. And again, you see this very striking symmetry, reflected symmetry, where when the dollar strengthens against the euro, we see a deviation of the cross-currency of the basis, where you have a more severe deviation from covered interest parity. Now, this is daily data. And so what I've done on the right-hand panel is just to plot the scatter chart of the value of the dollar on the horizontal axis. And on the vertical axis, I've plotted the 5-year, this is the 5-year chart now, the 5-year cross-currency basis of the euro against the dollar. And you see this very striking negative relationship. So this is not something that fluctuates on a low-frequency basis. This is actually something that varies on a day-to-day basis, and it really tracks very strongly the value of the dollar. So let's go back to an earlier question that I posed to you, which is the failure of covered interest parity purely due to tighter regulation, or is it due to some other factors as well? And it seems that it's not just regulation. If it were just regulation, we would see these things pretty constant, because regulation doesn't change on a day-to-day basis like this. There may be some complex interaction with regulation, but we don't really understand how that could happen. But certainly, I think what we can say quite safely is that it is not just regulation. There is also something else involved. If we think back to what happened in the sharp deleveraging during 2008, that deleveraging wasn't due to new regulation. That was due to tightening market conditions. And I think the action on Friday, where these gaps again opened up, is another instance where it's not just regulation that is causing these deviations. It's the interaction of whatever regulation there may be with market risk factors as well. So it's about risk-taking capacity interacting with market risk factors. But I suppose a more intriguing question here is why is it that a stronger dollar is capturing the idea of a market risk factor? And I suppose we understand this much better for emerging economies because we understand better the currency mismatch. But what this series of charts show you is that there's something else going on in advanced economy currencies where the parallels might be actually quite a lot closer than we may think. Now, we need to understand this better. and we're continuing to work on these. But here's one possible scenario that we could consider, which is the connection with the hedging needs of large investors. Now, to the extent that investors face currency risk, they may choose to hedge that currency risk. And if we think to emerging market pension funds, those emerging markets that have funded pension systems, we know hedge actively their global portfolio of assets. And because they have dollar-denominated assets, they will need to hedge that in order to satisfy the obligations to their domestic policyholders. But it's really the institutional investors from advanced economies, from the rich economies with very large global portfolios of assets, who will face this hedging imperative in the most stark way. And the way that you would hedge currency risk would be to sell dollars forward to a bank. But then the bank in turn will have to then lay off that risk, and the bank is going to lay off that risk by borrowing dollars, so that the dollar assets are now counterbalanced by the dollar liabilities. So what we would expect is that the dollar liabilities of the global banking system is going to be very closely lined up with the hedging needs of large investors. And the upshot is that banks take on liabilities denominated in dollars in the process of providing hedging services. And one hypothesis that is worth thinking about is that the breakdown in covered interest parity and the way that these things go towards a negative covered cross-currency basis is a symptom of the tighter dollar credit conditions that are putting a squeeze on accumulated dollar liabilities, which were built up during a period when dollar credit was much easier. And so the fact that the cross-currency basis is now coming down into further negative territory as the blue line goes up is a sign that as the dollar is strengthening, that is really putting a squeeze on these dollar positions that were built up to hedge the currency exposure. Now let me turn to the macro implications, and even here our intuitions are not great, it turns out. Now, exchange rates affect the macroeconomic outcomes through two channels. So the first works through trade and net exports, which is the textbook channel. And here a depreciation is expansionary by increasing net exports. The second channel is the financial channel. And as Jaime mentioned earlier, at the BIS we call this the risk-taking channel of exchange rate movements. And the idea here is that when there is a currency mismatch on balance sheets, an appreciation strengthens the balance sheet of the borrowers with the foreign currency liabilities. And then this will lead to greater investment. It may lead to stronger fiscal positions due to greater activity, and therefore it could be expansionary, at least in the short run. If you look at the left-hand panel, this shows you the relationship between the value of the dollar, which is measured along the horizontal axis, and the growth of cross-border bank lending in dollars, which is measured on the vertical axis. And the slope of that line indicates that a 1% depreciation of the dollar is associated with a 0.6 percentage point increase in the quarterly growth rate of cross-border lending denominated in dollars. And so this is a sense in which when the dollar is weakening, we see an expansion of dollar credit. When the dollar is strengthening, we see these things contracting. On the right-hand panel, I've indicated here the relationship between the dollar and the sovereign yields in domestic currency. So there's also an implication in terms of the yields as well. And these are for emerging market sovereigns only, so that when the exchange rate appreciates, when the local currency appreciates, this is associated with a compression of the credit spreads, even for domestic currency sovereign bonds. In the annual report, we go into some of the details of the precise mechanisms. But let me show you quantitatively how large these effects are what this table shows you, and let me just spend a couple of minutes setting the background to this. This is a table that shows the results of a panel regression, where the dependent variable is GDP growth. And we're seeing how much GDP growth depends on exchange rate changes. And here we're going to examine two exchange rates depending on the particular mechanism in mind. So the first exchange rate is the trade-weighted exchange rate, and that's indicated by the variable REA, which is the real effective exchange rate. And what we see is that the coefficient on the exchange rate variable is negative, which is to say, when the exchange rate in trade-weighted terms appreciates, this has a contractionary effect on output, which is the standard textbook channel. That's the Mundell-Fleming channel. But if we look at the second row, which is our second exchange rate variable, the DWER stands for the debt-weighted exchange rate. This is the weighted average of the bilateral exchange rates with respect to the currencies that denominate external liabilities. So these are for the main global currencies. And here we see that the sign flips. It goes from negative to positive, which is to say, when the exchange rate appreciates in this financial sense, it actually turns out to be expansionary. There's another element to this, which is that when we compare well, there are two elements. The first is that it only works for emerging economies. It doesn't seem to be there for the advanced economies. For the advanced economies, it's mainly the trade-weighted channel which seems to be at play. But for the emerging economies also, there's a difference between the short-term effect and the long-term effect. The short-term effect seems to be larger than the long-term effect, which is to say, the short-term stimulus that comes from an exchange rate appreciation turns out to be larger than the eventual long-run effect on output. So this is very much consistent with the credit boom that may accompany a period of currency appreciation. So let me circle back to discussions about. I suppose one lesson that we can draw from those slides is that there is something very important going on between financial intermediation and macro. We don't often make that link, but there may be a very important link there. And let me just conclude with a few remarks on prudential policy. Now, when we discussed the failure of covered interest parity, we discussed how that may be due to the impairment in the risk-taking capacity of financial intermediaries. And so we should consider how the risk-taking capacity of the intermediation sector is actually determined. Now, by definition, total assets is the product of equity and leverage. And although leverage may be limited by regulation, another factor limiting leverage may be some market factors that could be constraining leverage. And a useful analogy in this context is between the total assets of an intermediary with the total capacity of a building. And the equity of the intermediary is rather like the size of the foundations of the building. And the leverage is like the height of that building. And the total capacity is the product of the two. So if the leverage is constrained by market risk, as we saw, like the strength of the dollar, this is rather like saying the height of the building is constrained by market factors, so something that's beyond leverage, something that's beyond regulation. Perhaps the ground is too soft to bear the weight of a tall, narrow structure. And so in that case, another way to increase the capacity of the building would be to build on a broader foundation, which is to build on a higher base of equity. And let me illustrate this point with this slide, which captures the relationship between bank equity and lending for a group of 105 advanced economy banks. The left-hand panel shows a scatter chart that plots the relationship between the cost of a bank's borrowed funds with its overall leverage. So as you go to the right, the bank is more leveraged, and the height of the dot gives you the funding cost of this bank. Now the scatter chart is quite dispersed, but this is a summary chart of the means only, so it overstates the noise. When we do the detailed empirical analysis, we find that more equity is associated with a significant reduction in the cost of the bank's funding. And if you think about it, this is quite natural. If you have a stronger balance sheet, then of course you can borrow on more favorable terms. And the middle panel shows you that the lower funding cost translates into greater intermediation activity. This is the less leverage you have, the greater is the growth of your borrowed funds. And the upshot is that we see that in the growth of lending. So the right-hand panel shows you that as the leverage becomes smaller, the growth rate of lending is also higher. So what we find is that a 1 percentage point increase in equity as a proportion of total assets is associated with a 0.6 percentage point increase in the annual growth rate of lending. So in this respect, prudential policy towards a better capitalized financial sector turns out not only to be conducive to greater resilience, but also conducive to greater risk-taking capacity in support of more liquid financial markets and better market outcomes, better macro outcomes. So just drawing all the strands together, I've covered a number of topics this morning, such as market liquidity, currency market anomalies, and the impact of exchange rate changes on the real economy. Now, although these themes appear to be quite disparate, they turn out to be all related, and they can all be understood better by reference to the accumulated stocks that are driving the realignment of the global economy that Jaime mentioned earlier. And here, the stock is specifically of the stock of dollar-denominated debt that's outside the United States. And I've concluded by giving a statement of the benefits of prudential policy.